All right, welcome back. Let's spend a little bit of time now on the fourth step of our 7 steps we're going to cover. We're going to talk about just the idea of determining free cash flows to a firm. I want to talk a little bit about some things. Just as a quick introduction here, the main goal is to actually show that traditional approaches are fine, not in any way to say they're wrong, but we can actually simplify the process effectively by reducing the amount of time we spend on adjustments to adjustments, which just confuse us as humans. And if you're a robot, pay no attention to this. I'm not really speaking to you. And I think worse, move us away from actually the stuff that we want to matter. So that matters. So where we should spend our time. So this next lesson is kind of a way of challenging the traditional ways we present free cash flow determinations that we use in discounted cash flow valuation models, not because they're wrong, but because they might be a little roundabout or circuitous and not necessarily I guess our goal is to reduce errors and to save time, assuming that we have scarce time. And how do we focus on the meat, the plant or animal-based meat of what we're doing instead of just the adjustments to adjustments? And as a result, hopefully reduce a lot of the mistakes that we see made, because as humans, we just get confused by adjustments to adjustments. That's not really a natural way to think about things. So let's jump into it. It's our fourth topic of 7. We'll get into this. And I'll quickly remind us of this, not just to be clear. The main goal of valuation is to spend time on the drivers of value. And so the entire series here I want to emphasize is, we're not losing sight of that fact that for businesses, the drivers of cash flows are revenues and operating expenses. Let's focus on that. Let's give them salience and prominence, because that's what's relevant. And let's reduce just the extra steps that we have or might be common with traditional approaches. The traditional approaches, again, are fine, but they just make the whole point of this less accessible, more errors, more issues. All right. So here's a kind of a comment I want to start off with here, because this is commonly done. I've obviously seen this many times, talked to tons of students and professionals who kind of get at this. Many people will start their valuation with something like EBIT, earnings before interest and taxes, EBITDA, earnings before interest, taxes, depreciation, amortization, free cash flows, et cetera. And I want to emphasize that again, you could still get it right. It's not necessarily wrong, but it kind of misses the point of valuation, which is to estimate how much value a company can create through running its business. And so a DCF, a discounted cash flow valuation model, worth making. If you're just going to jump to the shortest way to do it, well, why do it? And certainly don't challenge the market with the result of something that's just like shortcuts and adjustments and misses out on what's the business and what do they do. So if we re-emphasize what's the business, the how of valuation, not just the what of the adding and subtracting, that's going to be continued conversation on revenues and expenses. I want to let them come through here. All right. So here's what I have. A little bit wonky on this slide. I admit that. That's fine. Hopefully it kind of makes sense. Please pause and slow down if you ever need to on any of this stuff. So I have kind of 2 sets here of common ways of doing it. On the left-hand side, the one that I didn't put in the box that says do this is like a traditional approach to what we see with free cash flow valuation in a DCF. And I want to emphasize that this is not wrong, but it likely is going to increase mistakes, and it moves us away from the prize. It moves us away from what we actually want to do here. We can start with net income, of course. You make adjustments, and then you sort of arrive at whatever it is you think you need: EBIT, EBITDA, free cash flows, et cetera. Humans are going to make a ton of mistakes in those adjustments, right? Professionals, et cetera, we make a ton of mistakes. In surveys that I've done with students, what percent make mistakes in those things? Very high, nearly 90, 95%. And that includes individuals with 4, 5, 10 plus years working in these kind of functions of forecasting and modeling, et cetera. Not because people are dumb or anything like that. It's just that adjustments are confusing. We really have to put extra mental effort into it. But the nice thing is we don't have to do them, right? So that on the left-hand side, the traditional way of doing it is just adjustments and adjustments. And the crazy thing is, if you really step back and think about what we end up doing here, we undo a lot of those adjustments. So we're doing adjustments to adjustments. Like you're moving forward just to eventually move back and back that out. Try to reduce that stuff, right? Because that's where we make mistakes. That way we kind of lose sight of what we're doing. And that's very time intensive. On the other hand, the way I actually say here is like, look, let's just talk about what we're actually doing with valuation. So focus on the drivers of value, not on abstract adjustments. Start with our forecast of recurring revenue and expenses. If you're doing this for enterprise value, you would not be including interest expense. So we do need an adjustment, but I feel better making an adjustment than adjustments to adjustments and tons of them. And then we're actually basically there. So you could think about, I've basically done it. My value is determined by revenues minus expenses. If you're looking at it from the perspective of equity holders, you actually leave everything there, revenue minus all expenses. If you're looking at it from the perspective of all providers of capital, you need to make that adjustment for interest expense. So then you have to make the determination for working capital, and then you'll subtract growth CapEx. I'm not completely covering the process here. I just want to introduce it. Importantly, if we did them both right, we get the same answer. But the issue is that the left-hand traditional way is just more likely we'll make a mistake. But if you did it right and you went through all this process, made sure you didn't make any mistakes, you would get exactly the same answer here. All right, let's jump to kind of an elaboration of what I mean with the way that I emphasize that we do. The focus on the drivers of value, one. So I kind of have each set here in color-coordinated buckets to make some sense out of it. When we start with our forecast of recurring revenue and expenses, what are we basically doing? It enables us to focus on the business itself. We spend time on what matters, what actually drives value, growing revenue, improving operator profitability then. Our forecasts already include the recurring activities. And so even if you yourself, looking at a company's historical performance, said, I think this is one time or non-recurring, that's okay. That's not a problem at all. That's exactly why we analyze the past historical financials. And then we wouldn't forecast or model that. So what if there's a historical one-time non-recurring item in our data that we've downloaded? Not a problem at all. Our forecasts are just actually going to exclude that. And that works well because instead of just seeing a summary metric where we really wouldn't know about one-time items, we get to break it into parts that matter, revenues and expenses. The same thing we want to do actually with net working capital here, which is that we just want to make sure that our assets and liabilities of operating assets and liability, which naturally translate to working capital, are sustainable, right? So we have like a reasonable balance of inventory and accounts payable and accounts receivable and accrued expenses and everything else. It's not out of whack. So that's, again, the historical data is the starting point, but we can disagree or actually ourselves forecast a more sustainable aspect. As a result there, we're going to see that the working capital actually doesn't make a massive material difference because once we achieve some degree of efficiencies, or we will achieve some degree of efficiencies, we're not really going to change our cash flows in a material way. I'm not saying at all with our working capital. So you're going to get, and you have to hit those efficiencies, or you'd expect to hit those efficiencies, at some point. Like you can't just keep having less and less inventory because if you had no inventory, you wouldn't be able to have sales. You can't keep having less and less accounts receivable because if you did that, you would just not have any sales on account. That may turn off customers. You can't keep extending your payment terms for your accounts payable because your suppliers wouldn't do that. So all of these, those are just three common operating assets and liabilities, but all of them are going to kind of hit like a steady state or sustainable aspect there. That matters for this reason. As a reminder, when you're going through your valuation, make sure that your value is driven by your revenues and expenses. Working capital is an adjustment that we need, but it's not itself going to be a material driver of value. So like if that's a big, massive, growing positive number that is dwarfing something like your net income, there's something wrong with the valuation, right? That's a mistake. Not that it can be a small number. It can, kind of offset, positive, negative a little bit over time. So it can have some effect, but if your working capital is your primary driver of free cash flows, that can't logically exist. There's a mistake. I don't know exactly what the mistake is, but you can't. A simple way to say that is a business model is not built on not buying inventory or not paying suppliers or only collecting cash from customers and providing them with nothing. That would be like a situation where you'd have like increasing free cash flows from working capital. But those are definitely not business models. They could temporarily happen. So you have 1 year, we have a big, you have positive change from net working capital. That's okay. But that can't be the driver of value. So as a gut check, make sure that your driver of value, like your biggest contributor to your free cash flows, is your net income. The rest are just small adjustments. And then subtract growth CapEx. I want to emphasize this. This is a difference because we're not, as you see here, we're not doing the weird add back for depreciation only to remove it in the next line with subtracting total CapEx. Another benefit of this, there actually is a clean and intuitive link between growth CapEx and future revenue. So growth CapEx is the amount of incremental capital you deploy in your company to grow your revenue. And it's just nice to see that. Then we should model it that way, right? Give us a clean and intuitive look. I put in this incremental growth CapEx. I get out this in the next period with revenue. That's a nicer way to think about this than if I lump together all of my CapEx, I don't really have a good awareness of how much of that CapEx is going to just maintain my revenue. So maintenance CapEx would be the amount of CapEx I spend to maintain revenue and earnings. And our best proxy for that is depreciation. So we can just leave depreciation in as a use of resources. We don't need to do the artificial adjustment and removing it. We leave it in as a use of resources like every other expense. So back to the last lesson, I talked about why, if you think about it in terms of cash flows, economics, even impact on taxes and everything else, depreciation is virtually, roughly, right, the same as cost of goods sold, sales and marketing expense, all of those things, right? They're uses of resources that we're either going to pay, we did pay cash or we will pay cash. So we're not getting out of that. But in this case, if we just focus on letting all expenses stay in, don't make the adjustments, then our CapEx is not the total CapEx, it's the growth CapEx. And the beauty of that is it gives us a clean and intuitive link between, okay, if this is my growth CapEx, there should be a correlation or a relationship between the growth CapEx in one period and revenue in future periods. All right. Check out and read these again. These slides, I didn't want to just exactly read it all to you, but there's a little bit of dense knowledge here. Unfortunately, I think it's just kind of worth slowing down and working through. So I do recommend that. I want to kind of repeat some general ideas here on this slide just to cover kind of why I want to take this simpler, less adjustment focus approach. Time is limited. And so if we focus on what matters, we can say, like, the less time we spend on adjustments to adjustments and roundabout aspects of valuation, the more time we can spend on the hard part, trying to figure out what do we expect the revenues and expenses to be going forward. We're actually still, what's a specific way we could spend our time, which I cover a lot in my financial statement analysis classes, is looking at the historical financials, company-specific information, context, read the footnotes, everything else to figure out what's the core and recurring aspects of the business itself. That may change, but like make sure that your stuff is like based on data, right? Hey, I don't know the future, but at least I'm saying, given this change or given this recent update in the last quarter, the last year, I expect that revenue I expect that operating margins will increase or decrease. So still try to make this a factor information based. We're making estimates. We don't know the future, but still the best you can understand the past, read filings, read footnotes, read management commentary, read the question and answer session of a conference call if they have these things. Every company has, their financial filings, and there's so much information in there. I mean, that's really the main point of our financial statement analysis class, that like, if you want information about a company, they all bare their souls. I mean, like completely put so much stuff in the 10K. Now, they're long, right? 10Ks are over 100 pages. And I'm not saying every page is super valuable, but like, within that 120 pages, there's going to be 10, 12 pages that are going to tell you a lot of things that are really valuable for valuation. So spend your time obtaining company-specific information and try to spend less time on adjustments to adjustments, which just lead to mistakes. All right. I talked about that, the main drivers. Hopefully we've made that clear. And that matters for this reason again. In valuation, we should spend our time on the things that drive value. We shouldn't spend our time on little nitpicky bookkeeping adjustments, add back, EBIT, EBITDA, depreciation, all those little weird things. Again, you can get it right, but don't spend your time just sort of pretending to do valuation. Get to the animal or plant-based meat, revenues and expenses. Spend your time there. There's so many things to try to figure out. That's time-consuming enough. I understand the business. Read good, read the footnotes, math good, kind of just a couple comments I make there that relate to my financial statement analysis class. And if I can kind of offer just a commentary there, the main thing is that you have the opportunity there's good information out there. Seek it, use it, focus on the core business. Don't get distracted by acronyms and adjustments to adjustments and intentionally inaccessible processes, which are very common. All right. So another language kind of way to think about this is like, why do we want to focus on what's included and drives value, revenues, expenses versus these weird adjustments? We'll reduce mistakes. I made that comment. So the adjustments to adjustments confuse humans. Adjustments confuse humans. Adjustments to adjustments certainly confuse us. Huge amount of mistakes. Again, a lot of pre-semester surveys I do in my FSA class make it clear that, a lot of them actually ask questions like, what does this adjustment do or mean or whatever else? And collectively our answer is, and again, if I just looked at students who've been worked as investment bankers, what's the impact of interest expense, capital structure? What is CapEx? We just make mistakes. We make mistakes because these are layered things, and it's the superficial answer isn't always the full answer. Right? Include core expenses. So this is kind of the point I made before. I think it's worth repeating here. While a bookkeeper or someone with bookkeeping envy may think about like, oh, non-cash, this or that, non-cash. Virtually all expenses are non-cash. So it's not really, that's not a useful label. That's unhelpful. It's an unhelpful, weird segregation that doesn't actually get us to what we need, which is the economic essence. Expenses are uses of resources. As resources are used, the investors don't have those resources. That directly decreases free cash flows to a company. Let's acknowledge that reality. Also, there are estimates of those expenses in the forecasting, not the companies. There are forecasts. So you can't argue that, well, I think they were distorting this or that. It's our forecast, right? So that's my comment there about like owning our own work there as well. The forecasts appear to our own stuff. We shouldn't add it. If we think something's wrong or manipulated or just incorrect, that's our own work. So that doesn't really make any sense. So even if you're saying, well, I think depreciation methods, blah, 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 it's your own depreciation expense. It's your own set of expenses. So it doesn't make any sense to intentionally put in a distorted metric just to remove it in the future, right? And in general, avoid distracting labels and processes. It's not value. It's tough. And there's no easy way to do this. So the less we can spend time on just confusing the hell out of ourselves with those labels, I think the easier it'll be, right? So it's not about mindlessly counting cash or pretending that core recurring expenses don't exist. It's about revenues and expenses, understanding the business and fleshing that out with firm-specific information, right? Extra commentary there. Hopefully that's useful there. And then this is my comment. I'm not going to read this whole thing to you, but if you can, kind of just check this out. I take the traditional approaches and I kind of point out all the potential mistakes and limitations of it. Again, not that it's wrong, as it'll get you the wrong result. It's just a simpler way for me to address this slide is basically, say you're starting in Austin, Texas, and you have to drive to Houston. You can either drive directly to Houston or you can drive to Chicago first. And I'm arguing just drive directly to Houston, right? Just drive directly to Houston. Don't drive to Chicago first. But the traditional way of doing valuation says, no, drive to Chicago first. We could get lost. We'll obviously spend more time on gas, right? Like there's just things can go wrong. Could you still get to Houston? Yes, you can. Yes, of course you could. So I can't say, oh, that's wrong. It's just that is that really the best way to spend our time? Adjustments to adjustments, kind of just waving our hands and running in a circle. My personal opinion is no. It's hard enough. It's time consuming enough. Just get to the point of it all. All right. So a couple of quickly here. We have all those adjustments, and those adjustments are going to lead to a lot of actually weird questions if you start digging into it. Now, I don't mean if you just automatically receive this stuff as truths, maybe like, oh, that's what I do because that's what I was told to do. Fine. But if you really think it through, there's a lot of inconsistencies in those adjustments. Like, wait, if I'm doing this, why am I not doing this? And if I'm doing this just to back it out, why did I do that? Why did I go 4 steps forward just to take those exact same 4 steps back? Right. So that's if you really think about this, you don't need to do this if you don't want, but I recommend that you do. So there's a lot of stuff that actually doesn't really make sense. Like, why wouldn't we back out all non-cash expenses like cost of goods sold, which is a non-cash expense? Because we record it, we don't decrease the cash account. The other thing, though, is that as we add them back, we're going to have to make extra adjustments. Working capital changes actually sort of offset some of those other adjustments. So that's a little bit roundabout process. Not wrong, but roundabout. Increase the chance of mistakes. And then I comment there about total CapEx, which is like a much harder way to look at this. So really pause here, kind of check out all the limitations of the traditional approaches, just so you can spend a little time reading about what I had there. And I finish it off with just like the extra point on stock compensation, right? Which is commonly called a non-cash expense, but it directly decreases company value because it's a use of resources. There's now going to be equity shares outstanding, and all else held equal, the extra shares outstanding with the same company is going to dilute or decrease the value per share. So non-cash expenses directly decrease value. The non-cash label segregation is unhelpful. It takes us a step away from the economic or business reality. And if we focus on revenues as the cash inflows from creating value for our customers, and expenses, no matter what label we stick on them or silly sticker we put on them, expenses as uses of resources, the primary driver of value being created is going to be net income, right? Revenues minus all of our expenses. We don't need all those extra adjustments. All right. I have here worth repeating. I think it is hopefully a little bit of repetition here, but we would be undoing our own work. So if you're saying that you forecasted depreciation and then you backed out your own depreciation only to then consider it in total CapEx, that's weird, right? It's not maybe not wrong, but it's weird. It's saying you're intentionally doing it wrong to fix it and then to add it back in. All right. So Also, we might overlook one-time items. So if you're using EBIT or EBITDA or just free cash flows itself as your starting point, then in those cases, you might actually have been using an item that actually didn't adjust out one-time items. If you start with revenues and expenses, you can more naturally focus on the core recurring business. And as a result, reduce the chance that you're going to build in your model something that's one-time or non-recurring. But if you look at like an EBIT or an EBITDA, those common metrics, earnings before interest and taxes or earnings before interest, taxes, depreciation, amortization. A glaringly obvious flaw about both of them is that they don't remove one-time gains, losses, and other items. And so they're going to leave that in, and then you would build your model, your valuation off of something that could completely include one-time non-recurring items. That's a big mistake in valuation. If we start with revenues and expenses, we're going to greatly reduce the chance of making that mistake. All right. And then aggregate, like this, we should split apart things that should be split apart and combine things that should be combined. So growth CapEx is the driver of future revenue. Let that stand alone. Don't mix that with total CapEx, which would include just the amount we have to spend to stay in business. All right, again, pause, read all these, listen to them all, work them out on your own if you want a little bit extra here, but I'm going to wrap this up. So good. I'll get into the specifics again, a little bit more on building intrinsic model in the next lesson. This was a little bit of a step back to talk about why we can simplify the process, and hopefully through simplifying the process, we can raise up the importance of revenues and expenses, and we can decrease or de-emphasize the roundabout adjustments to adjustments that are unfortunately very commonplace, because I'm assuming you're a human watching this, not a robot. Humans, we get confused by adjustments. We get extremely confused by adjustments to adjustments. And as we take our eyes off the thing that matters and drives value, there's a greater chance our valuations will make mistakes or overlook key things. I want to recommend we try not to do that when possible. All right, I'll wrap it up. Take care.